So the first question is, what are the type of payments which are covered under section 195? When I look at the type of payment which are covered under section 195, they basically fall into two categories. Specified interest payments, right? When I use the word specified, the reason is that there are some interest payments which are excluded from section 195. I will just come on to that in a moment. And then there could be any other sum chargeable to tax. Now, chargeability to tax is the most important thing for a sum to be liable to deduction under section 195. What this means, we have a complete slide on this, but what you should consider now is, if a payment is not chargeable to tax, then section 195 is not applicable. Now, any other sum, right? Now, when you talk about any other sum, there may be various kinds of payment which might be made to a non-resident. But such a sum should be a sum which is other than salary, because TDS on salary is deducted under section 192, irrespective of the fact whether this is made to a resident or a non-resident. Means that if a payment is made to a resident which is in the nature of salary, tax has to be deducted under section 192. Even if it is made to a non-resident, even then the section 192 is applicable. Now, like I told you, the deduction of tax on interest under section 195 excludes certain payments. So section 195 is not applicable on the following interest payments to non-residents, right? Even when such interest is chargeable to tax in India. If it was not chargeable to tax in India, then in any case section 195 was not applicable. But even when these interests are chargeable to tax under the Income Tax Act, read with the relevant treaty, then also section 195 is not applicable if the payment in the nature of interest falls under any of these three headings, which is interest on infrastructure debt fund. For this, the withholding tax has to be applicable under section 194 LB at the rate of 5% plus surcharge. If it is in the nature of interest on external commercial borrowings, so if an Indian resident takes a loan from a non-resident, it is called external commercial borrowing. Now, there are various guidelines in RBI relating to who can borrow, who cannot borrow, what are the conditions of such borrowing. All that is not a part of this particular presentation. But if you are making payment in the nature of interest on external commercial borrowings, then that is liable to withholding tax under section 194 LC at the rate of 5% plus surcharge. Interest on certain bonds or government securities which are issued to foreign institutional investors or qualified foreign investors are again something which are not covered under section 195. The withholding tax has to be applied under section 194 LD at the rate of 5% plus surcharge plus cess. But one point I may need to make here is that such interest payments to get the lower withholding under these sections should be covered under these sections. If a particular interest payment is made which is of the nature which might be covered here, but it does not satisfy the conditions of this section, then the lower withholding tax rate here is not applicable. Then you might have to go back and see other provisions of the Income Tax Act which might be covered, right? So suppose if there is a debt fund, but it is not an infrastructure debt fund, right? Then in that case, this lower withholding will not be applicable. Okay? If there is a loan which is not in the nature of external commercial borrowings, so suppose a non-resident invests into an Indian company through compulsorily convertible debentures and the Indian company pays interest on such debentures to the non-resident, right? They will not be something which is covered under this particular section, and therefore section 195 may be applicable, right? Now, when we talk about any other sum chargeable to tax other than salary, like I said, salary is covered under section 192. The type of payment which may be made could be in the nature of royalty or fee for technical services. It could be specified interest. We've already discussed that, right? Dividend, capital gains, business profit. So a non-resident may get royalty income from an Indian company. They may get fee for technical services. They may get specified interest other than the ones which we had discussed in the previous slides, because if they are covered there, then this section is not applicable. Dividend, of course, if the dividend is exempt from tax in India, then there is no relevance of this particular section. Capital gains, if a non-resident who owns shares in an Indian company sells such shares to another non-resident or maybe even a resident, right? The buyer has to withhold tax. Business profits or other income of the non-resident. So these are some of the illustrative payments. There could be others also, but these are some of the payments which could be chargeable to tax in India. Now, some of the points which we need to note here and which we are going to discuss in the next slides also is that payments in the nature of interest, royalty, fee for technical services and dividend are taxable on gross basis. Gross basis means that whatever is the payment for such services. So let's say if you pay someone $100 for fee for technical services, the TDS has to be withheld on this 100. But the situation might be different if the recipient has a permanent establishment, a PE, or a fixed base in India, right? In those cases, you need to see what would be the tax rate, and the deduction may also be on a net basis. Payment of salary to non-resident, because it is covered under section 192. Section 195 excludes dividend on which dividend distribution tax is paid by the Indian company and which is exempt in the hands of the non-resident shareholders. So if an Indian company pays dividend to a non-resident but pays dividend distribution tax on it, then such dividend is exempt from tax in the hands of the non-resident. Like I said, if it is exempt, then it is not sum chargeable to tax, and therefore there will be no withholding tax under section 195. Again, certain interest payment to non-resident are also not covered under section 195. This we have already discussed in the preceding slide. This should be preceding slide. Again, there are certain specific payments which are not covered under section 195. The reason being that they are specifically covered under certain other sections. So salary to a non-resident, 194E, payments to sports person or sports associations, 194E, payment to non-resident sports person, entertainer, sports associations, then 194LBA, specified income distributed by business trust to non-resident unit holders, 196B, income from mutual fund units referred to in section 115AB, then income from GDRs referred to in section 1155AC, income of foreign institutional investors, winning from lotteries or crossword puzzle, winning from horse race, or income in respect of investment in securitization trust. The reason for all this is very simple. If there's a specific section which provides for withholding tax, right, from payments to non-resident, those sections will override the provisions of section 195, and therefore the withholding tax will be done under the specific section rather than the general provisions of section 195. If the payment is not covered here, then you go back to section 195. Payments taxable on gross basis. Like I told you in the preceding slide, there are certain payments where the withholding tax has to be applied on a gross basis unless PE or a fixed base exists. So what you should do is, whenever you come across some of these payments, right, you should first see whether the non-resident has a permanent establishment in India or not. If he does not have a permanent establishment in India, the taxability will be on a gross basis. But if he has a permanent establishment in India, and the relevant clause in the treaty of the payment, let's say for interest or royalty or etc., provides that in case a PE exists, the taxability has to be under Article 7 read with Article 5, right? Then you should apply those provisions. Otherwise, the tax has to be on a gross basis. We will discuss all these aspects in detail as we move ahead. So payment in the nature of interest, royalty, fee for technical services and dividend are taxable on gross basis. That is, no deduction is allowed for any expenditure. So if suppose you are making a payment of $100 as fee for technical services to a non-resident, and let's say the tax rate is 10%, right? Then the tax to be withheld in India will be 10% of $100 or $10, right? If there is any surcharge or cess which is to be applied on top of this, you should apply, but that will depend on whether you are opting under the Act, whether you are opting under the treaty. Again, this aspect also we will discuss later. And the withholding tax rate of 10 or 15% would be applied on the amount of remittance to be made to the non-resident, right? So if you have remittance, when I say here, it actually refers to the fee amount or the interest amount, whatever that might be. If the terms of the treaty provide otherwise, they would override the above. So you need to see the specific terms in the treaty. If the treaty says something else, then that has to override this. So the payments which may be taxable on gross basis could be interest, royalty, FTS or dividend. Similarly, there are certain payments which are taxable on net basis. So certain type of income are taxable on net basis, which means that suppose you make a payment of business income to a non-resident, which is amounting to $100, right? Assuming this income is taxable in India and the non-resident has incurred expenses of, let's say, $70 on this amount, then $30 is what is his income, right? In this case, the withholding tax rate will be applicable on $30, that is on the net income and not the gross amount. So the withholding tax would be calculated on net income after allowing deduction for expenses as per the IT Act or the relevant treaty. So how this 70 will be arrived at is something which you need to see the provisions of the Income Tax Act or the relevant treaty and see whether it is 70, 40 or whatever. The nature of income which may be taxable on net basis could include your business profits, income from immovable property. Suppose a non-resident has a immovable property in India and he gets rental income, then of course there are deductions, standard deductions or other expenses which may be allowed as a deduction as per the IT Act. Capital gains, of course, cost of acquisition, cost of transfer, all that has to be deducted. Income from independent professional services, something like a professional or a consultant, if he is rendering some services in India and he has a fixed base in India, then their income is also to be calculated on a net basis. But yes, like I said, if the terms of the treaty provide otherwise, they would override these provisions. So payments taxable on net basis includes business income, capital gains, independent personal services and income from immovable property.